Presidential Wealth Management. On this Eagle's Nest webcast, we're going to point out some similarities that may help your investment plan and your golf game. First, let's put the two together. Here's a quick summary of what happened in the market so far this year, but we're going to do it in golf terms. It was as if the investors were all sandbaggers. Every drive was a dog that would hunt. Every putt was inside the leather. But in March, the market duck hooked. It was a full Ted Kennedy into the cabbage. There was no mulligan, no USGA, no breakfast ball, and no foot wedge. Traders hoped for a platypus, but it seemed like all they had were mud balls. You couldn't hit hosel rockets or fried eggs, and you didn't dare use your chicken stick. The dance floor read like a Russian newspaper. Flushers made it seem like the balls were totally afraid of the dark, and even three jacks were hard to come by, and it left a lot of us with a permanent case of the yips. So we're going to help you with that by comparing wealth management to golf with a special guest who is very good at both. Presidential Wealth Management's Marilyn Weaver, an advisor and certified financial planner with 25 years of experience. Marilyn earned her Ph.D. in endowment management at the University of Denver. Marilyn, thank you so much for joining us. And I have an observation for you, and I just want to run it by you with your experience in both of these things, wealth management and golf. I love golf. And over the years, I've concluded that the only true opponent I have is myself. And the way I can prevail over that opponent, myself, is by learning to eliminate everything except 100% of my attention focused on the target, focused on my goal. And it seemed to me as I jotted that down earlier today that applies in financial wealth management as well, does it not?
It does. One of the things that I've noticed, whether it's playing golf or trying to evaluate investment managers, is that the ones that exceed our expectations are the ones that have the most amazing consistency again and again and again. So we're always looking for those kinds of managers, and we're always looking to be that consistent as we advise our clients.
Stay with us. We're going to go a little bit deeper into the comparison between winning at golf and winning at financial wealth management. This is the Eagle's Nest podcast. For Marilyn Weaver and Taylor Leary, I'm Keith Weinman, coming to you from Presidential Wealth Management.
Well, a lot like my golf game, I think we're going to get deep in the weeds here, and very excited about that. My name is Taylor Leary. I am a certified financial planner and wealth advisor with Presidential Wealth Management. I'm very excited to be joined today, as always, with Keith and Marilyn. For some housekeeping items before we really dive into it and check things out, I just want to run through a few things. Number one is introduce you to the chat feature. So today, with the ongoing conversation, we want you to be engaged with the conversation. So what we've done is open up the chat feature. Now, what we've done is we've kept it private in nature. So it's not going to be a public forum. So with those messages, we know that there are questions, there are comments, there are some concerns that people have about their financial situation, and especially around all of the things that have happened over the last 16 to 20 weeks or so. It's been kind of a wild ride. So use that chat feature to, again, post your comments, post your questions, or just start the banter. It's going to go to the three of us, so we'll do our best to answer those in real time. If we don't get to them at that moment, we'll do our best to circle back before we end today. So again, use the chat feature over on the right-hand side of the screen. and post those questions, comments, or concerns. I do not have any poll questions today, so you're off the hook. But in future webinars and in past webinars, we have used that feature pretty regularly. So none of that. But I do want to bring to light the value of meeting with one of our advisors. We under the offers tab, we have the ability, or you have the ability, to select a schedule now, and that's a 15-minute call with one of our advisors. We have some unbelievable, caring, knowledgeable, and very experienced advisors at Presidential Wealth Management. So if you have questions, or you're not currently working with us and just want to get a second set of eyes, use the schedule now to schedule a one-on-one call and figure out if we might be a good fit for you. Now, we're going to dive into the meat of today's conversation. And I love it. When Marilyn came to me, she said, we want to talk about golf, because she's an avid golfer, and how that relates, just through her time of playing on the course. There are so many analogies, there's so many things that similarities that go with golf. And so I got very excited, because immediately my head went, all the way down the rabbit hole as far as you could absolutely take it. And so with that, I want to bring to light a few questions. And I personally love golf. Golf is one of those games that just seems so simple. And just because it's simple doesn't mean it's easy, right? You just take this little white ball and you just go put it over in that hole right over there. Seems simple enough, right? Investing is very similar. On paper, it's, buy low, sell high. Pick quality investments at a reasonable price, hold on to them, and then sell them at a gain. Seems simple enough. But I have a sneaking suspicion that there's a little more depth to that, at least when you brought that to us. So Marilyn, in your experience and through your years of working as a financial advisor and then also playing golf, how did you identify the massive similarities between the two?
Well, it started out as I was looking at the game of golf, and had started taking lessons again at Golf Tech, and realizing that you have to go back to the fundamentals to get better. I remembered one guy that I played with, and he said he'd been on the pro tour, and he said, golf is a really easy game. You just hit it straight. And I was thinking, yeah, sounds easy to me. And, and that's kind of what we do as investment advisors, is we say, investing is really easy, but sometimes, especially when the market's just going straight up, right? So if we could only find a market that always goes up, being an investment advisor would be an easy thing. But just like in golf, there are always the tough shots. There's always the course, and that every shot ends up in a bunker. Every shot ends up in the trees. So sometimes we have to figure out how to get out of the weeds, so to speak, with our golf game as well as with our investments.
Out of the cabbage, right?
Right.
Yeah.
So one of the things that you identified in preparing for today is the ability to evaluate investments. And you use this analogy of a bogey versus a par versus a birdie. Dive into that a little bit. Tell me a little bit more about, how you kind of identify, especially when it comes to the investment strategies that you use, and how you relate that to golf.
Well, I started off looking at it, and I said, most of us want to, in a perfect world, shoot par. So par is that shot that says, if I play this course well, then that should be what my score should be. Right? Mm-hmm. So par is that index, or that basic number that we're trying to achieve. And I looked at that and I said, that's very much like investment managers always trying to meet their index. They want to meet or exceed the index. The index may be the S&P 500. The index may be the Dow Jones. It could be the Russell 1000, depending on the asset class they're managing. So my thought was, first of all, how many money managers can beat their index, and how many golfers shoot par, right? So if those are, and what I found out is, there aren't very many people that actually shoot par. Even the pros that, an average golfer in the United States shoots 101, 101. I don't know, but that's 30 points or so above par, right? So you go, wow, that sounds like me. It sounds like I can be average. Well, guess what? Our investors, the people we work with, don't want average, right? They come to us because what they're looking for is how to achieve something above average. So what's above average in golf, right? You've got a birdie. A birdie means that you had one less stroke per hole, or an eagle, you had two less strokes per hole. And then you look at the pros and you say, what's an average? What are the best golfers shooting? And the best golfers right now have an average of 68. I don't know. That's not an eagle. That's not even a birdie, right?
Yeah,
so it's
right.
really hard to beat par, and it's really hard for our money managers to beat their index. But guess what? There are some that do that.
Absolutely. And so the evaluation process, and we were talking about this, you bring up the likes of like a Brooks Koepka or, even like a Tiger Woods, although he's fallen off over the years. And one of those things is consistency. And anybody can go out there and have an okay round. Now, maybe a hack like myself, maybe shooting a 45 on the front nine is a really good score, and then I go in the back nine and blow up and shoot a 55. and so with that though, I think one of the differentiators, I have a really good friend that I grew up with. He went on and played D1 golf, and he's a very, very good golfer. And his brother-in-law also is actually on the pro tour as well. And we were talking recently, and he was telling me that, on any given day, he goes out with his brother-in-law and he can beat him or at least play right with him, right? But the challenge is could he beat him over 4 games or a tournament weekend? And that's really the differentiator between, somebody like my friend or his brother-in-law, is the consistency of getting that subpar or under par type of day. Because you could go and if you're in a tournament, play really good on Thursday and Friday, and then if you just blow up on Saturday, you're completely out of the running. So when it comes to looking at money managers, a good money manager or a halfway decent money manager could say, I got great returns in 2019. Well, the market was up and it was doing really well. How do you go about your process of identifying that consistency of beating quote unquote par?
One of the things that we do is screen all of the money managers on a monthly basis. So depending on the asset class. So I'm talking about mutual funds or separately managed accounts. So in a mutual fund, using Morningstar, we can actually screen the performance of the mutual fund managers, their performance on a monthly basis. So what we're looking for are those that have been able to outperform not only in that month, but we're looking at the 1 month, 3 month, 1 year, 5 years, and 10 years. So what that tells you is what they're doing now and what they've done in the past shows their ability to have what I call a repeatable process. Something that they can do again and again and again. And those are the ones that we're looking for. And we're looking for them doing it with less risk. Mm-hmm. So that's kind of and back to golf, that's the guy that can hit it in the fairway on the green and doesn't have to go through the trees.
I love it. Marilyn, a couple of short questions here. When you're going through that process and you're looking from everything from 1 month performance, 1 year performance, up to 10-year performance, which is more important, short-term or long-term?
I think we have to look at, after we've come through a tough time like this, excuse me, I think we have to look at the short term to get to the long term. Can I break?
Yeah, absolutely. No, take it. Get that water. Well, it comes down to, I think what we were talking about earlier is just this idea of, how easy it is to get there, and where variance matters. Where if you can be hitting it into the fairway, you're not going to be all over the map, and you don't need to make these amazing shots to make up those errors.
Very interesting comparison. And you're looking at long-term versus short-term performance. So, Marilyn, let's go back. So more important, long-term or short-term? And you said short-term to get to the long-term. But if you had to pick the two for a client, which is more important, a consistent and say a low or middle single-digit performance over the long term, or an upper single-digit performance over the short term?
I think we're looking for, in the short term, what we've got is for whether we buy them now, whether we've got somebody that can perform in this market. So then we go to their long term, because the long term gives me what they've been able to do again and again and again. But we got to have both. We got to have both. It gives me an entree into them if they're performing well in a difficult time, and it gives me confidence that they've been able to do it in the past.
Because and that you lead right into the next question that I wanted to ask you. What's more important, performance in an up market or performance in a down market?
Well, part of our screen is we look at what's called downside capture. So downside capture says, how well did you do in a down market? How much did you give back? Because everybody tracks what they do in an up market. Everybody tracks their performance, and we know what they do on 1 year.
And they tout it,
right? Yeah. But who gave it back, and how much are we going to have to recover of what they gave back to get that performance going forward? So we need both.
Because I've heard over and over again, and I've used the fact with clients that minimizing your loss in a down market is more powerful than getting the maximum out of an up market. For somebody who is accumulating over the long term funds that will generate retirement income for them for 20, 25 years, it is on balance perhaps more important to see how big of a hit they took in late 07, 08, and early 09 than it is to see how close to were they among the absolute best performers in 2019.
Well, and when we're evaluating money managers, we're looking at a market cycle. So if a market cycle is 3 to 5 years, then really we've got to give our money managers a 3 to 5 year period to see if they can get through the economic and the financial changes over a market cycle. So a market cycle is important, but we even go further than that, right? Because we want them to not just do well in the 1 year, 3 year, 5 year, which is your market cycle, but we're saying 10 years. So, because 10 years oftentimes includes both good and bad markets. And we want to make sure that we aren't having to dig out of a hole we can never get out of.
And then going back, that 10-year becomes your target. It becomes your goal. And you can get diverted. Remember, I had said that my biggest enemy in golf is myself. When I can't focus 100% of my mind on getting the ball where it needs to go, I'm distracted by other things. It is so easily for us in making investment decisions to get distracted from the long-term goal, which may be 10 years out, as you just said, get distracted by things that are going on in the market right now. And now I think the first half of this year is no better example of that.
And wouldn't you agree that in golf, what do we remember? We remember that one great drive, that one great putt. That
You're
one
going
great
to Tin Cup now.
That's what gets us back on the course for the next year after all the frustration. And exactly. But unfortunately, our money managers, we can't hire them for their one great year.
Right.
We've got to hire them knowing that they can do, that they are the Tiger Woods. They are, you know, they are the ones that can make it and make it and make it. So
Very valuable.
it's just, you know, and it's hard. It's hard. I mean, or everybody would do it, right?
Right.
So,
Exactly.
Marilyn, you were saying, and I would love to get your insights on this, is you were saying that the average golfer shoots about a 101 or something in that ballpark.
Beginner golfer. Yeah.
Beginner golfer. Okay. So, you know, to have a 20 to 25 handicap, which is, you know, basically 20 to 25 over, is not uncommon. That's probably fairly likely. And a lot of golfers, recreational golfers like myself, if we can play bogey golf, we're going to be pretty happy about that. And I look at that because something kind of brought to light, you know, that disparity between par and then where everybody else is, and how challenging it is to, you know, shoot a 72 or a 71, depending on the course, the course scoring. So with that said, we see that study after study after study shows that the average investor underperforms the market pretty significantly. Now, there might be aberrations of 1 year where there was, you know, they did really well in this year relative to the rest of the market. But generally speaking, over a 5 to 10 year window, the average investor underperforms the market by somewhere between 3 to 6 percentage points, which is pretty unbelievable, meaning they're in and out and buying and selling and kind of gyrating all over the place. And there is an argument to be said that hiring a financial advisor like us or somebody to manage that money is actually highly beneficial, and that you get closer to either beating those indexes, you know, S&P 500, Russell is the things that you mentioned earlier, as being really a great way to do that. You had hired a coach to teach you how to swing a golf club. Such a simple act, but very, very technical and actually very challenging to do that. Walk with me and give me some insights. Number one, why did you hire a swing coach? And how does that relate to maybe hiring a financial advisor?
And the reason I went to Golf Tech is because you're actually being videoed while you're taking your lesson, so you get immediate feedback. And so in some ways, it's almost like having technical analysis of your portfolio. So you have somebody that can tear apart all the pieces and tell you what they're doing and how they can do better. And that's essentially what taking lessons from a Golf Tech does for you, is it breaks down your swing, it breaks down all the fundamentals, and allows you to see them. Whether or not you like them or not is not always true, but you know, they usually put someone up like a pro next to your video, so okay, you get to see somebody that does it right, and then you get to see you. But you also get to see how you can get better faster. And I see that kind of as when we do comparisons of our money managers. So we take two like money managers and we put them side by side, and we do a total analysis of their swing, so to speak. And we were able to say, this is why this one is better. And that's how we bring value to our investors, because we can break it down quickly and help them make decisions based on their risk tolerance.
I love it.
That is an absolutely beautiful comparison, that analogy, because as you're explaining that, I'm going along just as on every word and realizing that you have to take an entire portfolio apart and look at each piece and make sure it's doing what it needs to do, because it's entirely probable that within a portfolio that, say, wants to achieve growth for somebody who's Taylor's age, or retirement income for somebody who's my age, each piece has a different function. Each function is important and it must accomplish that function. And same thing in your golf swing. Each part of the human body has a different function. That I've been playing golf for a long time, and I still don't have an accurate understanding of exactly what each part is supposed to do. Absolutely fascinating.
And just like our investors, understanding what all the parts do doesn't necessarily make your swing better, right? And so just because my clients go do their own research doesn't make their portfolio do better.
You have to put it into practice.
Right. So we, like our coach, or like, we get to coach them on what the parts mean as a portfolio versus a part. So and as we're learning as investment advisors, that is probably what I call the maintenance of a portfolio, is probably the hardest thing we have to do. It's easy to go pick companies and money managers. It's hard to maintain what their objectives are versus what their portfolio is doing.
And again, take it back to the golf game. Sometimes it's easy to understand what you should be doing, but you can go years incorporating that, turning that into a habit that's reinforced, where you automatically do it without thinking about it. And I've gone, I know what to do right, and yet I still go out and do things wrong.
So what you're talking about is, how do I turn thinking into execution? And and working with our clients, that's the same thing. Sometimes our clients are overthinking what they're doing, when what we really need to do is go execute. Wow. And oftentimes we're the ones that can help them execute their plan and not get caught up in what I call their stinking thinking.
Stinking thinking. And then that goes to not keeping it business, not falling in love with investments.
Correct.
In my mind. And there's so much psychology in golf, but there's psychology in investing as well. And I think we all probably see so many people that have owned something because their father owned it.
Right.
Or they have owned something because they've always owned it. And they've fallen in love with it. And it may not be functioning the way it was when your dad owned it. It may not be functioning the way it was when you bought it 20 years ago. Mm-hmm. Times have changed. And so it's psychology versus it's psychology, how it integrates with execution. Good God, there's almost as many moving parts in the investment decision as there are in golf.
And many times it's just as frustrating, because about the time, I don't know about you two, but about the time that we think that we've got a portfolio set up perfectly to meet a client's needs, then guess what happens? A pandemic.
Yeah, right. We must try our best as investors, and this goes to the investors, this goes to investment advisors, financial planners. Somewhere in that plan, we have to expect the unexpected, even though we don't always know what the unexpected is going to be. We can still take steps in that plan to be prepared for the unexpected.
And so much of it's, again, going back to fundamentals, right? So when we go through a pandemic, what do we do with our investors? We go back and reevaluate, what is your risk tolerance? What are your goals? What do you need to do now that things have changed? And so I think so much of what we do is helping people, guiding people through the process of investing, not just what's the greatest total return.
Exactly. And part of that for me, and I'm sure you guys as well, this past year has been refocusing clients on their long-term goal. And I was so fortunate that through 2019, and many of us at Presidential said, this just can't go on forever. And we had been conditioning our clients to realize there needed to be a pullback. There was going to be a pullback. The only question was when and how bad it was going to be. And the result of that, I don't know if you guys had this, but I had so many clients that put just a smile on my face from ear to ear when they called me and said, how much cash have I got? What can we buy? When the market was hammered down and everything was on sale. So, and that goes to like when I'm on the tee or I'm on the fairway or wherever I am, even if I'm off in the cabbage, I need to focus 100%, even more. I need to focus 100% on where I want to go.
Right.
Yep.
Exactly.
And sometimes it's in which club do I need to use, right? So to get, is it my wedge? Is it my this? Is it my that? What do I need to do to get out of, as you say, the cabbage? So sometimes it's choosing the tool, and what I've learned is as a financial advisor, I think I probably have and understand more tools than the average investor. So we know the tools that are out there. We know who to reach out to. We know the things that we can do to help a client reach their goals. So I say, come to us just like, your golf coach, and let us pick your tools. We hope it's not pick your poison.
Well, it's so funny that you mentioned that. And I think, when we were preparing, I talked about this idea of selection and selecting the right tool that's for your specific need. And when I was first getting into golf and learning how to hit these different clubs, I remember, and this actually just happened to me recently. I was on the course and we were at altitude and the wind was to my back, and I'm, 150 yards out, which is normally, in most cases, like a 7-iron for me. And I pulled out the 7-iron and the thing flew 15, 20 yards over the green. And so it was like, wait, can I really? Well, the reality is that I just chose the wrong club for that circumstance. And so when it comes to the investment strategy and the selection part, right now with bonds and all of the things that are happening with the interest rate world, it's really, really interesting because the 40-year environment of bonds over the last 40 years, it's completely different now. We have taken on new risks, whether it's, especially with, where our economy is today, default risk, interest rate risk, all of these things. So just traditionally using bonds as an example, maybe that's not the right tool for creating income. And we talked about this a lot in our practice, in our meetings, is, if we think about, my grandparents, maybe your parents or something like that, CDs and money markets, those created a significant amount of income, and it was really risk-free. Well, now to generate the same amount of income is you got to get way out on that risk ladder. And so I would love to hear your interpretation of that selection process, Marilyn, and just understanding how the conditions might change what you use.
I was talking to a client, and he's in his 80s, and so he was saying, back in the good old days, he said when I first retired, he said my financial advisor created a bond ladder, and he said that bond ladder was corporate bonds, and he said the average income I got from that bond ladder was 10%. and I was sitting, and he laughed, and I said, so do you think we could do that today? And he said, no one even ever mentions a bond ladder. He said, is there such a thing as a bond ladder anymore? And I said, no, not really. And so what we learned is that was a tool that he could use in the 80s that we can't really use today because there's not enough difference in the maturity and the income values of our bonds. So maybe that bond is not the perfect thing. So what have we had to do with bonds, right? To create more income, you have to take more risk, right? So we had to go out and get high yield bonds so that we could get 5 to 6%. And we've had to look at foreign bonds to try to get the 3 to 4%. So again, we have to know where to go, what tools to use, and where to go without totally violating the risk tolerance of the client. And we've got to make the income meet the need. So we're constantly looking for ways to match need with income. And that's, I don't know about you two, but that's probably the biggest challenge in my portfolios for people in retirement right now.
Yeah. And a behavioral side of it, you talk about risk, and we've talked about it a number of times with the money managers that you choose, but also when it comes to just our clients. Oftentimes, we'll meet clients for the first time that are in their, let's just say late 50s, early 60s, and they may not be where they want to be. They say, something happened in the past. They lost a job. They got hit with whatever it might be. 2008 took a crap on them or whatever, and now they're trying to make up for lost time. And when we first sat down and talked about this, the first thing I thought of is how often I get made fun of by my friends. Now, I might have an errant shot off the tee box. And my dad, I learned how to golf from my dad. and I end up golfing like an old man. They call it old man golf, and it's just about managing the course. Now, what my thinking is that oftentimes the younger me would have hit it in the crap, and then I go find the ball and I try to make the hero shot. Just up there, and I'm way farther away from the. It's just a shot that I'm not going to make. Tiger Woods wouldn't even probably try to attempt it. It's between two trees. It's over this thing. It's just the most ridiculous shot that you could ever think about. And now I've gotten to the point where, well, I've got to take my lumps. I've got to say, you know what? I'm going to just bump it out into the fairway and take that shot, or at least take the stroke, and then make a better approach from there. And what I find is that a lot of investors, their first inclination is, I just lost money in an investment, or I took a hit, and now I'm going to double down on the risk. And now all of a sudden they're putting themselves way over their head as far as what the opportunity really exists. And sometimes as an investor, you kind of just you can't really make up for lost time. You just kind of have to go forward and make those better decisions instead of doubling down on those bad decisions and really crippling you.
Well, and hopefully that's why, in a sense, we get to be their caddy, right? We're standing beside them saying, the better shot right now is not to try the hero shot, but let's just get back in the fairway. And so sometimes I think we're the caddy, we're the person sitting beside them saying, I think we can still shoot par on this hole, but we're going to do it this way. And so we can still beat the index or meet the index with our investments, but this is how we need to approach it.
That's
the value we bring.
This is so real, because I had this in reality just this morning, exactly what you just described. Taylor, that shot for you, that's called a platypus. Okay, the official platypus is out of bounds, then get back in and make par. Okay, right. And that's what you more or less talked about. It's a platypus. Okay, this morning, a client who bought an investment in 2013 or 2014, late 2013.
One of those years.
Yeah. And it went from $26,000 to $32,000, and then it dropped to $16,000 now. And so he's out of bounds. Okay, now how does he recover from that? Okay, do you try for the hero shot? Just like you said, Taylor, do you try for that hero shot from out of bounds? And in order to get the equivalent of the golf hero shot in investing, you've got to get a ridiculous return, which is way high risk. And that way high risk is the same risk as you trying to hit the ball out of the junk and make it to the green. Right. And then the caddy comes in and says, no, your odds of doing that are pretty slim. Why don't you just recover? So this morning, and I'm going back and forth here between the golf analogy and something very real this morning that I had with a client. We called a representative of the company, did a conference call, and we had a half-hour briefing on the future of that out-of-bounds shot. That investment had fallen to half of its value. And that conversation, it was actually the caddy, just in this case, the caddy kept his mouth shut for the most part, because the conversation between the client and the company representative led the client to conclude that he should keep the investment, because he said, surrounded by all the risk in the marketplace now and what it would take me to recover, it seems like I've got much better odds just holding on to this investment. And the golfer, the client, actually said, let's eliminate everything that's happened before today and make the best decision from where I am now, with the investment that fell to half price or the ball in the cabbage out of bounds. Make the best choice from where I am now. And that choice turned out to be keep the investment. And in the junk with the golf ball, that best choice would turn out to be get a wedge, get back out on the fairway where you've got a better chance of getting to the green. And
Go ahead. And hopefully you don't have the equipment salesman that's on the side that's saying, you know, if you just had my, club.
oh my God. Yeah.
And in the real world, we know that in investing, there's always that voice out there, whether it's on TV or radio, where they're saying, buy this. This will get you out of the junk.
Oh, yeah.
This will change your life. So they need the caddy. So we're going to stay the caddy. We're going to keep them steady, and hopefully we're going to make them shoot par.
I love that. I got some new clubs here about a year ago, and you go out there with this idea that it's going to make you it's gonna be the club, and I can't wait until somebody, maybe a Tiger Woods, writes the book. Instead of Lance, it's not about the bike, it's not about the club, it's about the 7 inches between your ears, right?
Oh yeah.
So when it comes to investing, we've talked about this a little bit or alluded to it, and it's about this idea of discipline. So Marilyn, you talked about discipline as it relates to how the SMAs or those money managers or the mutual fund managers, how they go about their investment process, how they choose and select the various investments. In our world, we use a disciplined approach as far as making sure that the front end we do the financial planning, and then the maintenance piece. There's always a process and there's a discipline that's related to that. And then as it relates to golf, one of the things that I have is I have a driver in my golf bag, like most people. And I always say it's my vanity club, because the driver's the big one. It's got the big head cover. It's the CU Buffalo, or it represents your school or whatever. It's the cool one, right? It gets on, and they always say drive for show, putt for dough, right?
Right.
And for me, it takes a lot of discipline to remember that I can't hit that club. and about one time every 18 holes, I get that inkling. It's usually a par 5. The fairway's nice and broad and wide open, and I pull that club out and I think, all right, here we go, Big Daddy. And I grab onto it, and I'm pretty sure that darn thing is cursed, because it's just like I get the yips on the tee box, just as you alluded to, and I cannot hit that darn thing to save my life. And so with that, how do you feel that discipline is incorporated not only in your process, but also from just the investor's side of things?
Like with your driver, what you learned is you probably go and practice, and you practice with everything but the driver, is my bet.
Yep.
So spending the time to get proficient with the driver is going to have to set you back some. You're going to have to take some steps backwards to go forward. And what we've found with our money managers in our process, our consistency, is that the money managers that are able to outperform, they, no matter what the occasion, no matter if the market's in a pandemic, no matter what, they have a discipline how they buy companies, how they sell companies. They what I call stay in their lane. If they're a large cap manager, they only buy large caps. They don't start chasing other kinds of small caps if they're taking off. So having that ability to stay in their lane, to stay consistent, and be able to do the things that are hard, like practice, is what makes them stand out and what makes them different. And that's what our screening does, is it helps us identify those managers that practice their driver, practice hitting their driver. They practice making sure that they have a price to buy, a price to sell, and probably the biggest discipline they have is a sell discipline. And that's probably one of the biggest questions that I ask my money managers is, okay, if a stock goes up to here and has met your objectives, when do you sell it? And sometimes and a famous one is Janice during the 80s, Janus had a great buy discipline, and they didn't know when to sell. So they'd ride stocks all the way up, and then they would ride them all the way down. And many of our individual investors, guess what? When you ask them, what was your biggest loser? Well, it went all the way up to 100, and then before it went back down to 20, and that's the one that they'll pull out of their bag. That's their driver, right?
Right.
So oftentimes that's the driver. They didn't stay with their consistency, and they haven't practiced what their discipline is.
Yeah, that makes a lot of sense. Keith?
Keep your eye on the target. Don't be distracted by where you're at. Don't be distracted by the short-term noise. Absolutely. We've gone places that I never would have figured. Marilyn came to us with this idea, and I loved it from the very beginning. But at the same time, I had no idea how it would turn out. You've brought up things that the parallel is absolutely fascinating. And I think it's easier for us to understand things when we can do it in analogy form or story form. How we're relating how the golf game the decisions you make in the golf game. Going back to Taylor, going back to Marilyn, what you just said, you've got a bag full of clubs. Each club does a different job. In an investment plan, you've got a plan with a bag full of investments, and each investment or each type of investment is there because they were designed and they do a different job. And you combine all the clubs together and how to use them, you get a good golf game, you hope. And you combine all the investments together and how to use them, and you get a good investment return, an investment result. I never thought we'd go there, but you're exactly right. Absolutely amazing. And golf, Taylor, you're exactly right. Golf is played in that 7 inches between your ears. It really is, and it's amazing to me how similar the process of putting together a plan to make sure that all you've worked for all your life and all you've saved is protected and is structured so that it can provide you the income you want to enjoy the rest of your life, which is likely to be a couple of decades or even more. And that's a process that should never, never, never be taken lightly. And I think the planning and the process that we're talking about, remember this. Next time you're out playing golf, really, and think to yourself how you're making decisions about what to do and how to achieve your plan. Have you done the same thing with a retirement income plan or a growth plan?
And do you need to check in with your caddy to see if what you think you're doing is right?
Yes, because you're not always going to hit it out of the park. You're not always going to make the right decision.
Yeah, and I had an experience. This was a couple of years ago, and I have 2 kids now, and I have all these activities that I like to do. And in my early 20s, I tried to be a good golfer. I always say I tried to be, and I made a concerted effort to be a good golfer. And then at 2015, I just kind of stopped. I said, it takes a lot of effort to be a good golfer. And I remember I golfed with my father-in-law, and he said, we were out there and we're on like the 3rd hole, and I'm getting frustrated. And he goes, Taylor, why are you frustrated? I was like, well, I'm just not good. I'm not hitting it like I'd like. He goes, how often do you practice? And I was like, well, I probably go to the range. And I started thinking about it like once a month between April and October, and maybe play 9 holes twice a month, maybe 18 once a month. And he goes, well, you shouldn't be good at golf. And it reminded me of what's happening right now. And it's happening in my demographic, or at least my age group, is a lot of these kids are going to the Robin Hoods of the world and buying up stocks and getting lucky, frankly. And it's very interesting to watch this.
Exactly.
Because it is basically giving them a tool to go buy that. And they shouldn't be good investors necessarily. There might be naturals out there that are good, but they're going to take their lumps and they're going to have their losses. And there's a lot of headlines going on right now that is saying, buy this, buy that, and it's going up and everything's going up. And it's just not that easy. And so it's very interesting when it comes to golf and investing, how the tediousness and kind of the nuance really does matter. And so, Marilyn, I really appreciate you being on today. Is there anything that you want to leave our viewers with as kind of something that they can put in their back pocket?
Well, just remember that just like golf, your financial advisor can help you establish a practice program. Your financial advisor can guide you, and we can help you hopefully stay out of the pitfalls that would normally happen if you chose to be a Robin Hood, chose to start to invest for yourself. And sometimes we can talk you off the ledge when you think that the world has failed you and that your investments are going south. So let us help you through the ups and the downs, and hopefully we'll have you and your golf game and your investment portfolio all flying like an eagle.
I love it. I'm looking for those albatrosses. That's what I need to have more of. No, it's remarkable the value that, for the 10 years that I've worked with you, is just the amazing process that you've brought to your business. And I think that that's something that I always look to is your diligence and your discipline and your focus on helping your clients. And I just get to see some of the back end work that you do with your the assistant, Chris specifically, and just the amount of focus that you guys put on the screening process and talking about this manager versus that manager, and just the nuggets of information that I've been able to glean from you just been remarkable. And so thank you so much for being on today. And so for our viewers, this has been a fun conversation. I hope that you haven't got nauseated by the amount of analogies that we've related to golf, but we've had a fun time with it. And as Marilyn says, if you need that caddy just to give you some guidance on what to do next, we work with people that do it, the DIYers that have their kind of quote unquote play fund, that we help with that, or we get the serious money, which is to say the money that you want to make sure is there for you, in 20 years or 30 years, or to leave to your children. That's where we focus our efforts on. We're not going to be doing the day-to-day, you got to buy this hot stock or that hot stock. We want to build a portfolio strategy that's going to be good for today, for tomorrow, and for 15, 20 years down the road. So if you're working with us, we really appreciate it. If you haven't had the chance to meet with one of our advisors, use the Schedule Now button in the Offers tab to schedule a 15-minute phone call with one of our advisors to see if we would be a good fit for you. And so we really appreciate you being on today. And Keith, take it away from there, my man.
Just a last thought that occurs, putting these two things together, just with one last quick thought. Never let emotion be part of your golf swing. You know what will happen. Never base an investment decision on emotion. You know what will happen there too. For Marilyn Weaver and Taylor Leary, I'm Keith Weinman. Now, remember also to hear this webcast, to watch this webcast again, just go to presidentialwm.com. And to get answers to your investment questions, go to Presidential Wealth Management. Call us at 303-694-1600.
FORE.
Presidential Wealth Management securities and investment advisory services are offered through FORE Financial Group, Inc., a registered broker-dealer, member FINRA and SIPC.